Well, joining me right now to discuss the state of the Indian economy and more, I have with me Neelkanth Mishra, Chief Economist, Axis Bank, and Head of Global Research at Axis Capital, joining in on the show right now. Neelkanth, hi, morning. Good to have you on the show as always. And firstly, wishing you and your team a very happy and prosperous Diwali.
Likewise, very happy Diwali to you and your team as well.
Neelkanth, is the state of the economy looking as happy though?
No.
Okay, clear and precise, and it seems like a very definitive, confident answer. What are the markers indicating? Why such a definitive no from your end?
See, the high frequency indicators have been slowing for a while. We have seen very sharp slowdown in everything from auto sales to cement sales to power demand. In fact, the incremental credit impulse is much weaker than it was in the last couple of years. So the question for the markets and for all of us is whether this is a temporary cyclical slowdown or is there something more serious? Because what's clear is that there has been a slowdown in government spending, which is now starting to pick up. So the first 3-4 months of the fiscal year were actually quite bad, but now we are seeing some signs that things are picking up. I think the monetary conditions also on the quantitative side had been quite weak for a while. And after the banks started to slow down lending around March, April, because their loan deposit ratios had gone to a high level and the regulator wanted that to be brought down, we kind of started what I think is a negative spiral, which is that, as you know, deposits are created when loans are given. So if the banks start slowing down credit, deposit growth started to slow as well. Now, that also, at least the first signs are that is starting to ease. So the RBI has kept overnight liquidity in surplus since July. We are starting to see the first signs that deposit growth is now starting to pick up. Now, in the next 2-3 months, as this percolates through the banking system and as the fiscal spending resumes, one should expect that this slowdown is temporary, but there is no doubting that the current conditions are far lower than what the run rate was 6 months back.
So you're not ruling out a structural slowdown, right? Is that what you're saying, Neelkanth? That maybe the best for the growth, at least in the very near term, could be behind us?
Actually, I would say the worst of the growth should be behind us in the sense that we may be going through what is a cyclical bottom. So the 7% odd growth that the economy can deliver, so if you see labor input, capital input, and total factor productivity, I think that framework still suggests that we should be growing at 7%. We have recently sort of re-emphasized that the return of the real estate cycle and the need to construct a lot more of power plants means that the investment cycle is still on a good footing. And therefore, it is unlikely that structurally there is a problem. But what we do need to see is a pickup in fiscal spending and some amount of monetary easing, at least on the quantitative side.
I was talking about the government spending. That part would be eased off, hopefully, once the state election spree is over. But do you think private capex is going to come back or not?
So these are two separate questions. Let me address the first one. So the fiscal slowdown has been at both levels. So there is the central government and there is the state government. So even state spending in the first 5 months, the capex was down 7% year on year. Remember that last year we had a front-loaded fiscal cycle, meaning that the fiscal spending was front-loaded. And therefore, the year-on-year numbers could be misleading. But what we have seen, even for the states, is that August was a much better month. And while the fiscal data for September will be available only end of this month, but in the next couple of days, but I think there are signs that that number should have been better. For the center, I think the roads and railways capex has been a bit slow off the blocks, quite possibly because after the code of conduct was imposed sometime in February, to around July, when the new ministers, or at least the new government, was fully in place, there was a slowdown in file movement, and I think those will take a while. So maybe Jan-Feb is when the high-frequency indicators should start showing a recovery. For revenue expenditure, there are signs that there is already a pickup at the central level. So yeah, I mean, I think we should be at the cusp of a recovery. On private sector capex, look, private sector capex for me is an outcome. What is the input variable? The input variable is the revival in demand for things that require the investments. And when you look back and see what had driven the slowdown from 2012 to 2021, where investment to GDP ratio fell from 34% to 27%, of that 7% decline, 5% was household investment in real estate. So it's only when the real estate cycle turns that you need a lot more of steel. And we have shown in our report that the growth in steel and cement demand when real estate construction is on an upswing is 4 to 5% points higher than what it is when the real estate market is on a downswing. And so it is only when you see that kind of demand visibility that capex numbers from the private sector will start to improve. And we are seeing that. So steel, clearly companies have announced major expansions. We have seen cement companies announce expansions. We have seen power companies. And so that's the second leg, which is that after 7-8 years of no capex in power, we now actually need power capacity. And remember that just announcements don't add to GDP. Just pre-sales of real estate don't add to GDP. It is when the houses start getting constructed is when GDP gets affected. And that's when the companies which are upstream start to see the demand and therefore start to invest. So private sector capex for me is an outcome. If the real estate cycle flourishes like it was the last 2 quarters, it has also slowed down. But as the fiscal monetary easing start to show up, if the real estate demand picks up, I think private sector capex will pick up as well.
So when do you think the monetary easing cycle will begin, Neelkanth?
So the monetary easing, there's a quantitative side and there is the cost side. So basically the cost of money and the quantity of money. I don't expect interest rate cuts to happen before April. There are quite a few people, because of the change of stance in October, who started expecting that there would be a rate cut in December. But some of the comments in that monetary policy statement, as well as I think the public remarks by the governor, I think should have signaled enough that December is not likely. The headline inflation, in our view, is not going to give room to the MPC to cut. Now, it is absolutely right that the MPC or the RBI should be looking at forward-looking indicators and not just acting on what's inflation here and now. But given how differently food inflation is behaving, I don't think they will be very confident about disinflation setting in, and therefore the room to cut may not be available before April at least. On the quantity side, I think the RBI can, and it looks like they're already doing so. So the overnight liquidity moving into surplus after July and is now starting to show up in the 3-month and 12-month funding markets. So the certificates of deposit rates on those have started to ease. They have not fully eased because some banks, I think, are still seeing some vestigial effects of the liquidity tightness. So they're still trying to solve yesterday's problem and therefore still holding liquidity, still aggressively bidding for deposits. But it's like in our markets, in equity markets as well, right? That when something turns, some investors are early at it and then some come in a bit later. So over the next 2-3 months, I expect that as the banking system starts to understand that this overnight liquidity surplus means that progressively the fight for deposits will ease, the credit growth should start to then resume. Because what we have seen is a very significantly weaker credit impulse in the first 5-6 months of the year versus what we saw in FY22 and 23 and 24. And therefore, on the quantity side, I expect that the RBI has already eased. Whether they will get the confidence to or will see the need to cut the CRR or not, I think that's the high frequency indicators as they emerge. And if the RBI feels that there is room for further, that is a need for further easing, I wouldn't rule out perhaps a cut in the CRR as well.
Interesting. Neelkanth, do you think that inflation is perhaps the sole reason, or at least a 90% reason why we are seeing that consumption juggernaut sort of slow down? And I'm talking about the sub-premium segments across the board.
Yeah, so inflation, so again, first part of your question got cut out. So I'm assuming you were talking about food inflation being the reason. And so the see, food inflation, the consensus view is that it's supply factors which are keeping food inflation high. Our view is that there is a very strong demand angle as well. Remember that in the last 3-4 years, we have seen 14 states. So, and this number keeps rising. So when we first wrote about it in July, it was 10 states, but now 14 states have announced income transfer schemes. So we have 2 lakh crores annualized worth of income transfers happening. These are benefiting 20% of India's adult women, and all in the very low income segments. So they are targeted at households which have annual incomes between 1.5 and 2.5 lakhs. It varies by state, which is why there is a range. Now, if you give people who earn or who had incomes of 12 to 20,000 rupees a month, if you give them, or maybe lower than that, you give them 1,000 to 2,500 rupees. This also varies from state to state. Obviously, the first port of call is food, and which is a good thing. And what this does is that the market, which has been somewhat inflexible, because as you know, in agriculture markets, there are too many constraints. So the supply has been, I think, slow to respond. And so what you see as high food inflation is actually, I think, perhaps because of demand factors as well. Now, this number, this 2 lakh crores, is not enough to sort of, in a 330 trillion economy, if you're giving an additional 2 trillion, that too has been building up over 4 years. That's not strong enough for it to offset some of the other factors which are visible in the FMCG space. So we have in the past discussed that this is an investment-driven recovery, and therefore consumption as a whole will grow slower than real GDP. Within consumption, the upper end segments will continue to do better than the lower end segments. Currently, both have been cyclically constrained as well because of the factors that I mentioned earlier in this chat. So there should be some recovery going forward, but I don't expect low income consumption to show a sustained recovery. And there's another factor. I mean, remember that labor force participation rates have started to pick up. So there is significant increase in the number of people who want to work, and that is visible in the last 4 years, very largely driven by an increase in female labor force participation rate. There are lots of questions on why that has suddenly happened, and it could be, I'm sure it is a very big contributing factor, that everything from availability of electricity, household automation, to the fact that people are living in pakka houses which are easier to maintain, that there are now toilets in the houses, that people have access to dense forms of energy like cooking gas or now piped water increasingly. So all of this means that there is more time that women can now spare away from home. And they are now showing that in, perhaps because of their low education levels for the adult women of today, they are entering agriculture, and that's freeing up male labor to do other jobs. And so there is an oversupply of labor, and that's keeping, I think, labor costs or the pricing power of labor weak, and therefore wage growth is slower. So I think those are factors that are going to be harder to address, and these are to some extent reflected in why income transfer schemes are taking off as well. This is the political system responding to these pressures.
Neelkanth, putting all these factors that we just talked about, highlighting the state of the economy right now, tell me what explains the kind of FII exodus that we're seeing. I mean, it was fine up until last year because you had a massive cushion of DII support. Well, the DII support still seems to be there sporadically. But I mean, FIIs have sold about 1 lakh crore rupees already so far this month. Is it just the China factor, or is it just realization of peak valuation market and then the slowing economy?
So I'm sure it's a bit of both. I personally don't think that it's a China versus India equation, in the sense that, yes, I think when China flares up by 25% and everyone is sitting massively underweight China, whether you are convinced about the recovery or not, the first thing you have to do is close the underweight. And when you have to close the underweight, of course, you then sell off the market, where you can sell at that scale without having much of a market impact. So it's quite clear that in a large part of this $11 billion or so that we have seen in this month is perhaps reallocation to China. But there are other factors as well, and our guess is that it could be new pods, hedge fund pods, which are responding to the data weakness, the fact that after nearly 1.5 years of continuous positive surprises on growth, that the Indian economy is giving negative surprises, and we are seeing very brutal earnings cuts across sectors. And in anticipation of that, it's a reasonable strategy to actually short the market. Now, the pace at which this has happened is absolutely unprecedented, in the sense that for people who have been looking at the markets for as long as I have, $15-20 billion a year was considered a very, very strong inflow or outflow over a year. We have seen $11 billion go out in like 25 days. And so while domestic flows, institutional flows, which are about, say, 4 to 5 billion a month, maybe 5 billion a month now, are very strong. I mean, these are unheard of numbers till a year back. The fact is that the pace of outflow from FIIs has far exceeded the pace at which the inflows are happening, and which is why you're seeing the markets sort of come off a bit. When the pace of selling abates from FIIs, one should expect that there is that much of a technical recovery. But remember that this has been accompanied by very sharp earnings cuts. So far, mostly for FY25, but I would think that FY26 cuts may also be possible. And therefore, the people who shorted the market may actually end up gaining. But from a technical, from a near-term, weekly, monthly trading perspective, it is reasonable to think that once the selling pressure abates, and maybe some of the people who are shorting are coming back to cover, the market would actually take a leg up. But remember that it is a stretched market, very high PE multiples. And till we see clear signs that the high frequency indicators are turning, it is better to be on the cautious side.
Absolutely. But what about earnings? I mean, can we expect more sort of EPS cuts coming in? Because Q2 has been quite the howler so far, at least, barring a few odd positive surprises here and there.
Yeah, so this should have been done by now, in the sense that the fact that September quarter had very weak volume indicators was known across the street. The way I have seen analysts across the street, and from the time that I returned to India in 2006, has been that when people put out quarterly forecasts, meaning that, what is my quarterly expectation, quarterly earnings expectation, they don't really revise the full year numbers, because they think that revising it multiple times, why go through that headache? So we will change the numbers when the results are updated. So what we are seeing from a market, I think to a large extent the market was aware of this, but still I think the pace of that cuts were needed. I think the scale of the cuts I think have surprised quite a few, and we still have another 15 odd days of results pending, and my expectation is that we will see more cuts. So far, FY26 has not been cut that much, so I think there is this assumption people are making that this is a cyclical slowdown and that by fourth quarter the recovery should be there. So I think that's in the consensus. Do we see cuts after the December quarter as well? Well, if the spending by state and central governments does not revive in full steam in the next month or so, then it is reasonable to expect that there could be another round of cuts. But if we see that, in 2 days we will see what happened in September from the fiscal side, and maybe in 2 months we will see what's happening on the easing of liquidity. I mean, is it now starting to show up in the 3-month, 12-month funding rate, so that at least the banks that are willing to lend have the capital and have the right channels, can they start pushing in some loans? And as that happens, I think then the cyclical recovery picks up, and then the risk of cuts fades away. But I would expect that there will be more cuts through this earnings season and possibly for the next earnings season.
So tying in with the economic markers and of course, what we've seen from the earnings so far, Neelkanth, where is it that you would say keep your sectoral overweights and underweights so far?
So this is something we wrote about maybe more than a month back, that in the period between say May, June and September, as the flows were happening, as the inflows in the domestic institutional money managers are happening, and those fund managers were seeing the data points that you and I were seeing, which is that the economy is slowing down, and they were kind of apprehensive that it is very risky to be buying the cyclical stocks. So what we saw was that IT, pharma, and staples outperformed significantly, and this was the market in a way, turning risk averse or sort of fortifying itself for turbulent periods. And this was despite the fact that staples earnings were still getting cut. Pharma has seen stable earnings, and the results also haven't been that bad. IT, the outlook was not really improving that much, but still these sectors had outperformed. So our view is, and I do think that the economy will see a cyclical recovery. So given how badly some of the deep cyclicals have done, our recommendation is to look at beneficiaries of cyclical recovery. And some of the sectors like cement really haven't corrected despite the very weak concurrent performance. But still, I think that still looks okay to me. I think some of the industrial names still look okay. And financials, frankly, are the cheapest sector. The raw material that they work with, which is the quantity of money, had been in short supply. And for what it's worth, the RBI is signaling that it is willing to provide the liquidity that is needed to sustain growth. And that at the margin, that means that banks that have the scale and the skill and the capacity to lend will be beneficiaries. So those would be my picks for the cyclical recovery.
Okay, on that note, Neelkanth, we'll let you go. Thanks as always for taking the time out, and wish you a very happy Diwali from all of us once again.
Likewise.
If you like this video, then like, share and subscribe to ET Now.